Okay. Good morning. I'm Stephanie Benvenuto, Chair of the San Diego Housing Commission Board of Commissioners. It is 8:02 on May 5th, 2022, and I'm calling to order the special meeting of the Housing Commission's Investment Committee. The process we're using for today's meeting is authorized by Government Code Section 54953E, which was added by Assembly Bill 361. This allows the committee to use teleconferencing and provide the public with opportunities to address the committee through call-in or internet-based options during a proclaimed state of emergency. And the City of San Diego City Council on April 26, 2022 declared that a state of emergency continues to directly impact the ability of members to meet safely in person. They also declared that this applies to all boards, commissions, and committees of the City of San Diego. As such, this meeting is occurring by video conference with all committee members and Housing Commission staff participating by video. For the record, I'll ask each committee member to indicate their presence as I say their name. Ryan Klumpner.
Here.
Keely Hubbard. Do you have Keely?
I didn't see her on.
Okay. There are no members of the public in attendance. However, members of the public may watch the video conference and hear the audio of today's meeting, which is being streamed live online. The agenda for today's meeting included a link to the website for the San Diego Housing Commission Board of Commissioner meetings, where the public can access the live streaming for today's meeting. The public has been provided with an alternative opportunity to provide comments to the committee through an online comment form and a toll-free phone number. A link to that comment form was included on the agenda for today's meeting, which was posted on our website, www.sdhc.org, on Tuesday, May 3rd, 2022. The agenda and public comment form explain that comments about items on the agenda will be read into the record if they're submitted by 4 p.m. yesterday, Wednesday, May 4th, 2022. Non-agenda public comments submitted by 7 o'clock this morning will be read into the record. There were no public comments submitted. In addition, members of the public who wish to speak on an item may call the toll-free phone number that's included on our agenda. Members of the public should monitor the meeting through the live video streaming that's available on our website, www.sdhc.org. Again, today's agenda included a link to the website where the public can access the live streaming for today's meeting. Members of the public should call that toll-free phone number only when their item is being introduced. If a caller begins to comment on an item that's different from the one we're currently considering, we'll ask them to hang up and call back at the appropriate time. Members of the public will have 3 minutes each to provide their comments unless a large number of people call, in which case we may limit them to 1 minute each. The phone line is now open to provide non-agenda public comments. You can call 833-610-2513 to be placed in the queue to provide non-agenda public comment. This is the time when members of the public may provide comments to the investment committee about topics that are not on our agenda but involve a subject within the committee's area of responsibility. We cannot take action on non-agenda public comments. Again, that number is 833-610-2513. We did not receive any written public comments for today's meeting, but I will ask our Director of Communications and Creative Services, Susie Kaywood, if we have any callers for non-agenda public comment.
Good morning, Chair Benvenuto. We do not have any callers at this time.
Great. We'll leave it for the remaining moments.
Yes.
Good morning, everyone.
Morning, Keely.
Morning.
How are
you? Good.
We're waiting on public comments, so we're running out that clock. We're not just sitting here silently. Don't worry.
Okay.
Good morning, Keely.
Good morning.
Chair, that concludes our time.
Thank you. We're going to move on to committee member comments. Committee members, do you have anything you'd like to address? Going once, twice. Okay, thank you for the head shake. Next on our agenda is the approval of the minutes from the meeting of November 12th, 2021. The phone line is now open for public comments about the minutes. You can call 833-610-2513, be placed in the queue. We'll take those comments following the presentations. I'm sorry. I got ahead of myself. I got excited there. Not get any written public comments submitted regarding the minutes. Again, that number is 833-610-2513. Do we have any callers?
We do not have any callers at this time.
Okay, so we'll go ahead and run that clock out, and then we can consider a motion. Thank you, Suket. I have everybody on the gallery, so your voracious head nods are keeping me honest.
I'm
I got this now.
no, I was laughing when you were reading the whole thing. I was like, yeah, there's no way you can memorize that whole thing. It's too much.
I keep thinking like, I'm getting it. Like, I know what's the numbers straight, and Scott does such a good job of making sure it's very like thorough and transparent, and I bungle it every.
He's not on the call, so we can blame him. But I always joke with him. I'm like, Chair Stephanie introduces the person, so why do we start and say our name again? And he's like, it's being recorded. You got to say your name again. I'm like, come on, God, I can save 2 minutes by not introducing myself and whoever else is with me because you said it already. So yeah.
I'm glad you asked that because I wonder if the same. Like, we're very thorough.
Very thorough. Yeah.
Okay.
Susie, don't say that to Scott. All right, that's an internal joke here. So
Noted. 15 more seconds.
Great.
Chair, that concludes our time.
Thank you. That concludes public comment period for the minutes. Do we have does any committee member wish to make any changes to the minutes, or do we have a motion?
So moved.
Great. I'll go ahead and second. So we have a motion by Vice Chair, or a motion by Commissioner Kuttner or Benvenuto to approve the minutes for the meeting of November 12th, 2021. For the record, I'll ask each committee member to say their vote on the motion when I say their name. Ryan Kuttner.
Aye.
Keely Hubbard. Keely, did you vote? I'll add my vote in favor. So we'll give Keely a second. But for now, that motion carries. So we'll move into our agenda items. This morning, we have 2 informational items on the agenda. The first is the fiscal year 2022 first quarter investment results. The phone line is now open for public comments about this item. You can call 833-610-2513 to be placed in the queue. We did not receive any written public comments regarding this item, but again, that number is 833-610-2513. We'll take those public comments after the staff presentation, which will come from Interim Chief Financial Officer Suket Dayal and Manager of Finance Accounting Operations Amy O'Connor, who will present this item. But also, congratulations, Suket.
Oh, thank you.
That's wonderful. Okay, whenever you're ready.
Yeah, I'm going to pass the mic to Amy. Amy is our Manager of Finance Accounting Operations, and she's going to provide the report.
Hey, good morning, everybody.
Good morning.
I'm going to share my screen. I'm going to go over the third quarter investment numbers with you. Our portfolio as of March 31st shows that the total market value in investments was approximately 182 million compared to the previous quarter of 211 million. These investments had a yield of maturity of 0.98%, average days to maturity of 541, and an effective duration of 1.38. The decrease of 28.8 million during the quarter was principally due to receiving 36.6 million of state and federal housing assistance stability funds and American Rescue Plan Act funds from the city of San Diego. Those receipts were primarily offset by 49.8 million of program administrative payments related to HSAP, 9.1 million of program payments related to the bridge shelters and other homeless programs, and 4.8 million in loans made for development projects. This shows the portfolio credit quality by quarter, allocation by quarter, the maturity schedule by years. You can see that more than 50% was is due to mature within the next year. And finally, on the last pages of the report, you can see that the detail of our investments. And that's about all I have. I'm going to turn it over to Joe Foy for his comments.
Good morning.
Good morning.
Let's see here.
I will stop sharing my screen if I can.
I think you have my report. I'm not sure how to share a screen, but I think you were all given my core portfolio report. And so this morning, I'll be here to present our core portfolio report. Basically, it's
I'm sharing my screen.
when we invest, what exactly do we invest in, and take a look at the results. So if we go to the page where it says San Diego Housing Commission Portfolio Summary, you can see that I have 3 years going out to 2018 and including 3/31 of 22, just to show comparisons of the different years and how the changes. As you can see, as of 3/31 of 22, we had a market value of 105,841,000. That will be slightly different than what Amy, and again, this is just the core, right? Portfolio. That'll be slightly different from Amy's because there are little pricing nuances. San Diego Safe keeps our bonds at US Bank, and my numbers for the bond pricing is off Bloomberg. So it's insignificant, but it is a little bit different. If you guys were to drill down, you'd see a difference. Our annual income at this point, again, this is static, so it doesn't take into consideration if a reinvestment is $3,068,000. Again, as Suket, Amy, and Tara are aware that that number is a lot higher. It's just that this is just a static number. Our average coupon is a little bit higher at 297. That's kind of a sweet spot for us between 2 and 4%. We're finding around at around 3%, and I don't anticipate that changing anytime soon. Our portfolio yield is at 138, slightly higher than at the end of December, but we expect this number to rise over the next 3 or 6 months as our lower yielding book yield bonds are rolling off, and with the higher rates, we're presented with opportunities that both Suket and Amy have been very proactive of replacing those lower book yielding bonds off with higher yielding bonds. So we should, at our next meeting in November, this number should be significantly higher. And again, it's being proactive when there are bonds available. We have money to invest to take action, and we've done a good job with that. And then finally, our duration is about the same. Remember, duration is just a measure of price sensitivity of a bond portfolio for every 100 basis point move. However, it's also used quasi as an average maturity, right? And the lower the number, the less sensitive the bond or portfolio is to a change in interest rates. So we're at a very conservative 2.32. We'll probably stay neutral there going into the fall, the summer and fall, but it depends on how aggressive the Federal Reserve will get and where we see rates are at. We could extend a little bit just to try to capture a little bit more yield. So again, there are a lot of different factors, but I think the main factor is where rates will be and what the spreads are going to be, which will determine whether we stay at this level, maybe extend a little bit, or maybe even shorten. It's kind of an ongoing process. If you look at the graph below, I put this 2-year graph below our summary just to kind of give you a snapshot of what has happened recently in the last month and a half, 2 months since March 1st, with the higher inflation, with the Fed's announcing of being aggressive. You can see the 2-year has risen significantly higher. Again, that's been a benefit for us as we are able to, again, reinvest at higher rates as the lower yielding rates are rolling off. And another consideration is the higher rates. In Amy's report, you see that we have in our short-term investments, LAIF, San Diego Accounting Pool, our restricted, non-restricted cash. With every Fed move higher, it's almost like we own a floating rate bond. As those rates move, as the Fed funds rate and the 2-year raises goes higher, those fund rates go higher. So it's instantaneously we're getting more cash based on the money we're sitting in cash. It's like I said, it's like owning a floater, moving right along with interest rates. So we go to our next page, just briefly, just a fixed income or distribution. And as you can see, we're concentrated in the 2 to 4 year area. We're not so concerned about some of the shorter maturity bonds. We have plenty of liquidity within our short-term investments. So we reach out to 2 to 4 years to obtain higher yield. And you can see, because we have monthly pay, the effective duration actually shortens up a little bit from the back end. But overall, this page just kind of just breaks down with the investments we have by coupon, by duration, by sector. We're 100% government agency. We had in years past done some FDIC CDs. However, those are just not an option right now, with banks not really printing those, and they're not very competitive rates. AAA for everything, etc. Next 3 pages. Like Amy showed, I have a little different format.
Could you tell me what page you're on?
Oh, yeah. I'm sorry. Let's do that. We're on page 3. Keep going. Wait, what happened here? We're on page 3. Can you move it forward, Suket?
Yeah.
It would be the other.
You know what? It's the joy of.
There we go.
Yeah.
There we go.
It's just loading. It should be loading now. Yep.
Okay. So move forward.
Next
Yeah.
page.
Yes. Next page. One more page. All right. So here's our portfolio, and I include this just to show the laddering effect. As you can see, where we try to have a security or multiple securities in different maturities. This adds just another layer of liquidity for us, and it also reduces any investment rate risk because we have bonds rolling off every month that we can reinvest. This is a standard practice for investment portfolios. I'm not the genius that made this up. It's just a standard practice of prudent investing. Next page. Okay, so I was thinking, okay, every meeting we speak on different subjects. We've talked about the Federal Reserve, the doves and hawks. Talked about debt ceiling, and I thought, okay, what could we talk about today? And I think the 3 main things we hear about is inflation, Ukraine, and China. And so I thought I'd leave the latter 2 behind. And let's talk a little bit about inflation. It's in the headlines. Unless you own an EV, every time we go to the gas pump or we go to the grocery store, we see it. It's real. And this chart here is a CPI chart, Consumer Price Index. In meetings past, I've always done the PCE, is what the Fed follows, but I thought CPI would be a little more appropriate since there's been price increases across the board in all categories. And so as you can see, from January of 21 until now, the large increase in consumer prices, pretty significant. And it's been, and I put the little red circle there because that is the day that Russia invaded Ukraine. And so we've had this higher inflation prior to that, and that event is going to only continue the inflation and make things worse. If you want to go to the next page, please. Thank you. So for a little content, I thought I would show going back to 05. You can see that we are significantly higher even prior to when we had this kind of this false a strong economy in front of the housing crash in 05, 06, 07. Even at that point, we were below 6%. So you can see how significant this last move has been. Next page. And even further back, because I was thinking back to the days of, probably a lot older than most of you, I remember the odd even days with gas back in the 70s. And so you can see how high it was back in the 70s as a comparison. But it, we look at our end and we're on that trajectory of going higher. So hopefully the Feds can do their job. Next page. So what's the Fed to do? All right, what's the Fed do here? Well, they started by moving 50 basis points yesterday. Now, this was printed prior to get the report out. So if you follow on the left-hand side, those are the implied rates of Fed fund futures, and that's a real active market. And on the right side is the number of hikes. Keep in mind, a hike is 0 to 0.25. And so 2 hikes basically is 50 basis points. And so you can see at the 5-4 of 22, they did exactly what this chart, the implied rates were saying yesterday. They moved it 50 basis points to 0.75 to 1%. So we're right at that number. Chairman Powell did announce yesterday that he has taken off any 75 basis point move, but has confirmed that June and July, they will move 50 basis points. And I think that calmed the markets yesterday. We did have a pretty good rally in the equity markets, though we're giving some back this morning. And the bond market actually rallied, anticipation of being proactive. And so him calming the market, he said all the right things to calm the market. But like I said, if you look at 11-2 of 22, that bar, you can see we are on pace to have about a 2.5 to 2.75 Fed funds rate. And that's what the market is expecting. And again, like I said earlier, we welcome the higher rates. And so how does all this relate to our portfolio? We welcome the higher rates. We can invest in higher rates as the older book yield bonds roll off. We are not a total return portfolio, but rather just managing cash flows to assist with the mission of the San Diego Housing Commission. Next page. So part of the this is the funds rate, what the Feds have done over the years, just to kind of take a look at how that all works. You can see that back in 98, 99, we had the .com bust, and so the Feds lowered rates. And then, of course, the 9/11 tragedy that we had to continue, went into recession, turned around, and we had the rise in rates as we were coming out of that and going into a housing boom, which we see the bust. And then we went to 7 years of just interest rates of 0 to 0.25 and carried higher as we came out of that. And then, of course, the pandemic hit. And again, the Feds had it ratchet down. The point of the graph is that as we move higher going forward, there will become a time, and history has shown us. Next page to get. Going back further, history has shown us that the Feds will overshoot, and we will have to bring rates back down. And part of that duration we spoke about earlier on the summary was, sometimes the argument is, oh, if you know rates are going higher, why would you not just have everything short? Because you're going to get a little bit better yield the following month. And the answer to that is that with these ups and downs, you want to lock some rates in the bonds you purchase. And so you don't want to be caught with all your bonds maturing right when rates are falling. And so that's why you would buy, bonds a little bit further out the curve, prudently, mind you, and keeping track of what's going on in the markets. But as rates fall, you want to try to retain and not have bonds maturing at the time when rates are falling, and then finding yourself having to reinvest in rates that are a lot lower again. Next page, please. Okay, so this is the 2 year. So we don't purchase bonds off funds rates or inflation. We purchase bonds off the 2 year Treasury, spread off the 2 year Treasury. And from the earlier graph I showed you, you can see the significant move we've seen higher in the 2 year Treasury, which has been to our benefit. Again, with Suket and AB being very proactive and having us, buy these higher yielding bonds. So you can see that quite a big move of 138 basis points in the last month and a half. Pretty significant. Next page, please. Again, just staying consistent. Going back from 2000, you can see that, yeah, we're at 270, but history shows it's really not that high. But again, we have these ups and downs, and if we were to map this on top of what the Feds have done, it would follow right along, right? Because the 2 year does lead. The 2 year does lead the funds rate. Next, please. And again, a little redundant, but going back further again to the 70s and 80s, it's funny. A colleague and I were talking how some of the younger folks that are on my side of the business, they've never seen a 6% funds rate. I mean, neutral used to be 3 to 6%. And really, if you look over the years, we've never been there. So let's see our next page. So this is, we've shown this graph before in past. This is the relationship between the 2s and 10s, and the reason 2 year and 10 year Treasury. And the significance of this is when the Feds are aggressively raising rates, there's always the concern that moving quickly into higher rates will cause a recession. And so when you have inverted curves, yield curves where the 2 year is higher than the 10 year, there's other indices, right? 6 month to 30 year, 5s to 10s. I've always liked the 2 to 10s. You can see, and if we were to map back on this, you would see that when they cross, typically there's a pretty big slowdown in the economy and GDP. Next page. So every quarter, the Federal Reserve will put out their economic projections. This was from March. And as you can see, back in December, they were projecting 22 of a 4.0 GDP. At that time, they didn't feel it was as the inflation was going to be as significant as it has. And we just saw this last week, GDP printed negative number. There will be 2 more revisions to that, and they're anticipating that to rise slightly above 0. However, you can see the Feds have adjusted it to a 2.8 for year end. Employment rates, employment strong. Average hourly earnings is strong, so there's no change there. The PCE, which I showed you CPI, back in December, they were thinking around 2.6. Now they're readjusted at 4.3. I think, while I'm in the camp, I think it's going to be difficult, and I think it's going to continue to be higher. With China in lockdown, with zero COVID, that's going to continue the supply chain issues, exacerbate them a lot further. And I think the Federal Reserve has a big job in front of them. Funds rate back in December, they were saying 0.9. Now they're at 1.9, but now we know that's different. That'd be interesting when we get the June economic projections that, obviously that number is going to change to 2.5 to 2.75. Next page, please. I just threw this in there. I thought it was interesting. I always have, the world bond rates. And as you can see, inflation's affected everybody in the past. Most of these countries in the 2 years, this is sort of about the 2 year, have been negative rates. And you can see that the last holdouts at this point is just Switzerland and Japan. Everybody else is a positive rate in the 2 year. And again, that's just a consequence of the inflation we're seeing and their central banks making adjustments. Next and final page. A little dated, obviously, just a snapshot of the equity markets year to date. Obviously, with the inflation and everybody's central banks having to make adjustments, it has affected the equity markets. I'm sure you're all aware of that. So, so in summary, our core portfolio and the portfolio in general, we're well within the HUD's PIH 96-33 guidelines. And with our own San Diego Housing Authority's investment portfolio, and being in summary, and we welcome the higher rates of being able to reinvest in higher rates. That's it.
Thank you. Susie, do we have any callers?
Chair, we do not have any callers at this time.
Okay, great. Thank you both for the presentations. Keely and Ryan, we melded them into one mega presentation. So if you're waiting for a report on market conditions and wondering what could possibly come from that, because we just covered it so well. Thank you. That was super relevant and helpful kind of to understand the broader scheme of where things are going. And just to distill this down, the commission remains at a very strong spot, right? That's
Yes.
the good news.
That's good news. Yes.
The rest of the world may be exceptionally volatile, but at least financially we're in a strong position. And historically, we've always done well when things got
Yeah.
ugly. So, commissioners, or committee members, are there any other questions? Something you'd like to add? No. Okay, that was a really thorough report. There is these were both informational items, so no action is required. We don't need a motion or anything. The next item we have on the agenda is to schedule our next meeting. So when we'll get together and do this again, I'm going to propose that we meet at 8 a.m. on September 8th, which is another kind of pre-session before our September commission board meeting. Does that date work with my fellow committee members?
Yes.
Okay. Yes, the 8th. Wonderful. Thank you. This concludes our special meeting today, and we are adjourning at 8:34. Thank you, everybody.
Thank you.
You're welcome. Thank
Thank
you.
you.
Bye.
Bye.
Okay.
Bye-bye. Thank you, Joe.
Yeah, I'm gonna have to learn how to share a screen here.
That's okay.
Yeah.
Good job. I'll talk
Could
to
I
you
have,
soon.
when
Oh.
Suket had that up there, could I have clicked on it to move forward, or did?
No, because
that's
he
his
was
screen,
sharing.
right?
Yeah, he was
Yeah.
sharing